It is the last Friday of February 2026. The Dow Jones just closed down over 1,000 combined points for the week. U.S. software stocks are down more than 20% year-to-date, the single worst performing sector of the entire year. Jack Dorsey just fired 40% of his company and told his shareholders that AI tools have fundamentally changed what it means to run a business. A viral research report called Ghost GDP is making Wall Street analysts genuinely terrified about the future of the American middle class. And Fortune magazine published a headline today that no one expected to read in 2026. From Ghost GDP to mass layoffs, this was the week America realized AI's white-collar recession isn't coming. It's here. That quote went everywhere. And CNN's headline today perfectly captures the biggest economic story of the year. The week AI changed everything. But while financial journalists are focused on the stock market destruction, the job losses, and the doomsday economic models, there is one asset that has been quietly benefiting from absolutely everything happening in this economy right now. That asset is silver. And I don't mean silver is doing okay. I mean silver is up 6.28% in a single day on Friday. I mean silver already hit an all-time record high of 121.67 just 1 month ago on January 29th. I mean, Bank of America's head of metals research just said silver could reach $135 to $309 per ounce before the end of this year. And I mean that the same AI revolution that is terrorizing white-collar workers is simultaneously creating the single greatest industrial demand explosion for silver in recorded history. Stay with me, because by the end of this video, you are going to understand something that most people on Wall Street right now either don't know, don't want to say, or haven't connected yet. Let's start at the beginning of this week, because everything that happened between Monday and Friday of this final week of February 2026 represents a turning point in American economic history. It started building weeks ago. An AI executive named Matt Shumer published an essay on X, formerly Twitter, that forcefully argued white-collar workers should be afraid of artificial intelligence. He didn't write it gently. He compared the current moment to February 2020, when the pandemic was rapidly approaching American shores and the public was completely unprepared. Shumer wrote that the disruption is here, it is accelerating, and that most people are dangerously in denial. That essay has now been viewed 85 million times on X alone. That is not a niche finance newsletter, that is a cultural earthquake. Then came the Citrini Research report. On February 22nd, just 6 days ago, Citrini Research, which runs the most read finance substack in the world, published what can only be described as a financial doomsday scenario. Written as a fictional memo from June 2028 looking back at what happened, it described an economy where AI agents rapidly replaced software engineers, financial advisors, middle management, and entire categories of white-collar knowledge work. The core concept of the report, the phrase that dominated Wall Street dinner conversations all week, was Ghost GDP. Here's what that means. Citrini argued that AI creates enormous economic output. Companies save money, productivity numbers look great, GDP figures look healthy, but that output never circulates into the real consumer economy. Because machines don't buy groceries, machines don't pay rent, machines don't take their kids to Disney World, the economic activity becomes invisible to the 70% of the U.S. economy driven by consumer spending. In this scenario, Citrini modeled what happens next. Prime borrowers, the well-paid white-collar workers who hold mortgages on the best houses, begin defaulting. The $13 trillion residential mortgage market starts to buckle. Unemployment spikes above 10%. The stock market corrects by 38%, and the economy spirals into a deep deflationary trap that is, in many ways, harder to escape than inflation. Critically, unlike most economic models, the market actually reacted to this report. Usually speculative finance essays don't move markets. This one did. The Guardian called it a feedback loop with no break. Forbes published a full analysis asking why a fictional memo just moved real markets. And the answer is simple. It articulated something millions of Americans were already feeling but didn't have words for. Then came Thursday, and Jack Dorsey made it real. The Twitter co-founder, who has been running payments company Block, stunned the entire financial community by announcing he was slashing 40% of his company's workforce. Not 5%, not 10%, 40%. And in a letter to shareholders, Dorsey used words that could have come straight from the Citrini report. He wrote that intelligence tools have changed what it means to build and run a company. Block stock actually rose nearly 14% the next day. The jobs vanished, the stock price went up, and that, in one corporate announcement, perfectly summarized the economic dislocation at the heart of the AI story. Companies become leaner and more profitable. Workers lose their livelihoods. Both things are true simultaneously. This was not an isolated announcement. Earlier this month, Anthropic made cuts, Nvidia made cuts, other major tech players made cuts. Matt Shumer, the AI executive who wrote the original viral essay, wrote on X after the Block news, "This is one of the first major examples of AI driving layoffs. but certainly not the last. If you're saying this won't happen to me, reevaluate your thoughts. Now, it may be the most important thing you do. And the stock market felt every word of it. The Dow Jones fell over 800 points in a single Monday session this week, down 1.66% in one day. U.S. software stocks are now down more than 20% for the year to date, making them the single worst performing sector in all of 2026. But perhaps no voice has been more powerfully validated by this week's events than Albert Edwards, the veteran macro strategist at Societe Generale. Edwards has been called a perma-bear. He has been called contrarian. He has also been called, on many occasions, correct. This is the man who first publicly raised the alarm about greedflation, the idea that corporations raised prices far beyond their actual costs during the post-pandemic era, deliberately extracting wealth from the working and middle classes. And this Monday, Edwards wrote in his weekly market note, "The AI macro doomsday scenario is not for 2028, it's here right now." He cited data showing the U.S. consumer is, in his words, running on fumes, and that American household income has hit a brick wall during the greedflation era. He was so alarmed about white-collar job prospects that he made a stunning personal statement. "I can honestly say that if I was 18 now, there is no way I would go to university only to leave with huge debts and poor job prospects. Instead, I would become an electrician or similar trade." Now, the human reality of this economic shift was put into precise, heartbreaking focus by a story Fortune published today. A 42-year-old woman named Nicole James built Snapchat's content team. She spent over a decade moving up through increasingly senior creative roles. She was head of content at an animation studio. She had never had a gap in employment in 15 years. Then the studio pivoted to become an AI studio, laid off half its staff, and Nicole James hasn't had full-time work since 2023, despite sending out hundreds of applications, despite the experience, despite the resume. She told Fortune, "I really felt embarrassed when I showed up to work the first day and put on my name tag. It's very shocking, like I just fell off a cliff and I don't have a flashlight." Lax Ganapathy, founder of the independent investment research firm Unicus, told Fortune she published a very similar research note back in January, but she called it the vibe session. Her prediction: companies will lean as much as they can, as fast as they can with AI, and that is going to cut a lot of jobs. And some companies in the process are going to completely stop existing as a going concern. She forecasts high unemployment and stubborn inflation running together into the second half of 2026, and she says the disconnect between what the data shows and what Americans are experiencing will only keep widening. This is the economic environment we are in right now, and this is exactly why what's happening with silver matters so much. Continued exactly as original text without any section headings or structural tables, no words changed. Important disclaimer. This video is produced entirely for educational and informational purposes only. Nothing presented in this video constitutes financial advice, investment advice, trading advice, tax advice, legal advice, or any recommendation to buy, sell, or hold any financial instrument, commodity, security, or asset of any kind, including but not limited to silver, gold, or any other precious metal. All prices, data, quotes, statistics, forecasts, and market information referenced in this video are sourced from publicly available materials as of February 28, 2026. All market data is subject to rapid change. Past performance of any asset, including silver, is not indicative of future results. Precious metals, commodities, and financial markets are highly speculative and volatile. You can lose part or all of any money you invest. Always conduct your own independent research. Always consult with a licensed, registered financial advisor, tax professional, or investment advisor before making any financial decision. The creators of this video are not licensed financial advisors, brokers, or registered investment advisors. All opinions expressed are solely those of the creators and do not represent the views of any financial institution, news organization, or regulatory body. Invest only what you can afford to lose. We are not responsible for any financial gains or losses resulting from actions taken after viewing this content.